The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Was it a skip or was it a pause? The Fed decides to do nothing. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're taking you to the closing bell here in the United States.
Here on the first Fed decision day of the new year, bringing a policy statement with no real surprises and no real shift in tone. Benchmark rates left unchanged at 3.5 to 3.75% with 2 dissents from the usual suspects and a slight upgrade in their view of the labor market.
Let's take a quick look at how that is translating into these markets. The S&P 500 pretty much unchanged on the day with the Fed standing pat. Same thing, too, when you take a look at the 2-year Treasury yield, where you are seeing some actions when it comes to the dollar rising as measured by the Bloomberg Dollar Spot Index. Fed Chair Jerome Powell had nothing to say about that, but the Treasury Secretary did earlier. We will get to that. And gold continuing its winning ways, now higher by about 4%, Romaine.
Yeah, that press conference with Jay Powell, entertaining to be sure, not so much because of the answers he gave, but more importantly, the answers he didn't give, batting down questions about his future, batting down questions about that Supreme Court case. He did have some thoughts, though, on the state of the economy and some advice for his yet-to-be-named successor. Take a listen.
The U.S. economy expanded at a solid pace last year and is coming into 2026 on a firm footing. There was broad support on the committee for holding today. Broad. We will see the effects of tariffs flowing through goods prices, peaking, and then starting to come down, assuming there are no new major tariff increases.
I'm wondering what advice you have for whoever your successor might be.
Stay out of elected politics.
Jay Powell just moments ago. As we count you down to the closing bell, Ken Shinoda joins us, portfolio manager over at DoubleLine Capital. And Ken, we weren't really expecting to hear a whole lot out of the Fed today, at least in terms of shifts in policy. But when you listen to the tone of the statement and of Jay Powell, are the expectations for rate cuts, at least based on economic conditions, is that still intact?
I think there's a chance for rate cuts, but I don't think it's till later this year. He's pretty happy with where policy is. He mentioned it many times that they're in a good spot, that the balanced risks of the labor market, inflation have kind of come down a bit. So I think they're on hold until the data tells them otherwise, whether the labor market weakens or inflation comes down more.
And I don't mean to be flippant about this, but are they effectively on hold until June 17th and they have a new Fed chair sitting?
It sure seems so. And I think that's what the market's pricing in. Basically, nothing till Powell's term is over, and then maybe at best 2 cuts through the end of the year.
And I'm curious to know what you make of the race for the next Fed chair. It seems like the short list involves, of course, the Kevins, Kevin Warsh, maybe a little bit more than Kevin Hassett, BlackRock executive Rick Rieder, and Christopher Waller dissenting today. I imagine that means he is still in the running. How closely are you watching this from the perspective of a portfolio manager?
I mean, it's just so volatile. I don't know if you look at the poly markets, they're very popular these days. People like betting on everything, up, down, left, right. And Rick Rieder's probabilities recently skyrocketed. He was like sub 10%, I think, towards the end of last year. So I feel like Warsh is a little close to the administration. And so I would put Waller probably as the front runner right now.
Yeah, well, I mean, you take a look at Polymarket, to your point on Reader's odds. I believe he's solidly still in the 40s right now. So, I mean, game planning this a little bit. If we are on hold until we get that June meeting with the new Fed chair in place, you have to imagine that they're going to lower interest rates. When with the expectation that, you know, we will get more cuts, it'll just be a few months delayed here. I mean, how does that translate into what you're doing in the bond markets right now?
Well, if they're not going to cut till, you know, sometime in the second half of the year, floating rate securities that people were worried the coupons were going to drop will earn a little bit more carry. So I think some floaters here are attractive. The bond market's been unusually stable. I mean, it's the 2 years been in less than a 20 basis point trading range. The 10-year oddly is higher in yield since we started cutting again last September, but still it's been in this kind of 4 to 425, 430 trading range. So here, credit markets, spreads are tight, but with earnings strong, I think credit can perform well. So it's kind of an earn your carry market in fixed income this year.
Any concerns, Ken, about some of the moves that we've seen in the dollar, and more importantly, the tone coming out of the White House with regards to what at least appears to be an avocation or at least some comfort with softness in the dollar? I thought Jay Powell kind of brushing that off, saying that's not really the Fed's purview. That's basically the Treasury's decision here. Any concern, any overlap?
You know, we've been talking about adding non-dollar diversification to your both fixed income and equity portfolios for almost a year now, and it didn't really work for a while until maybe middle of last year, and we still think that's a good idea. The dollar remains strong for a long time, but policies in place today, along with continued issuance of debt and fiscal concerns, I think it makes sense for investors to diversify both fixed income and equity portfolios.
Absolutely, and you have to imagine that dollar volatility, really FX volatility in general, will continue, Ken. But I want to go back to the point that you made when it comes to credit markets at this point. You called it sort of an earn your carry type of market. Where can you best do that right now when you take a look across the landscape?
Well, our favorite part of the credit market is probably shorter duration, where you can be at the front end of the curve. You don't have to take that much interest rate risk. You don't have to take much spread duration, which is the sensitivity of a bond to movements and spreads. So shorter duration type assets where you can still pick up, maybe 100, 200 basis points over treasuries. I think it's a nice place to kind of hide out until we get some vol. Hopefully we do get some vol. This has been kind of a boring market. Equities just seem to climb the wall of worry higher, and fixed income just kind of moves sideways. So as an investor, although it can be stressful, we enjoy these times of volatility because that's when you can find opportunities in the marketplace.
All right. Well, be careful what you wish for, Ken. I am curious, though, too, when you look at, particularly in the credit space, are you willing to take on a little bit more risk right now, or do you actually sort of just maintain a little bit more of a safer posture, if you will?
Yeah, the corporate credit markets have gotten very tight, especially high yield. We're approaching 250 spread on an option-adjusted basis, but there's still pockets in that securitized space. So things backed by, non-government guaranteed residential, commercial mortgages, parts of the asset-backed security market where you can still find, I think high yield type spreads with investment grade ratings. And so that's kind of where we're hiding out right now. We can still pick up kind of the same spreads that you do in double B, single B, high yield, but we've got structural protections in the capital structure, and we've got hard assets underneath those securities.
Ken, always a pleasure. Ken Shinoda, portfolio manager over at DoubleLine Capital, instant analysis on the back of that Fed decision in the market. Read on that? Basically, nothing's happening.
A little bit ho-hum, certainly when you take a look at the bond markets and the equity markets right now.
A full breakdown of all of today's market action and, well, a full breakdown of some big earnings crossing the wire in just a minute.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell with the global simulcast. Carol Masser and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Carol Masser, we should point out, I know it's Fed Day, but you have about $8 trillion in market capitalization set to report earnings in just a moment. Microsoft, Meta, Tesla, the biggest there. The Fed couldn't move the markets, but maybe those companies will.
I'm so glad you went there, because just tracking the markets, you're right. Nothing really happened. But I think these companies, because they are so big and they're so much in terms of their percentage in terms of the market cap and market overall, but also in terms of the narrative, where the spend's been happening, the AI story, we'll see whether or not we get a gut check on that and whether or not it's good or bad.
What does CapEx look like, especially from a company like Microsoft, a company like Meta Platforms, Katie? If Microsoft is spending money, it's a signal that others are spending money with Microsoft. If Meta's spending money, well, investors don't necessarily love that as much.
Yeah, not necessarily in either of those two names, though, I will point out. You take a look at Microsoft and Meta as compared to the other members of the Magnificent Seven. Over the past 3 months, these are your two worst performers. So there's a lot of skepticism, to your point, Tim, exactly on that CapEx and where it's going for both of those names.
I'm sorry, for our TV viewer, did you two get evicted from your old studio or something?
We forgot to make the rent payment.
Yeah. All right, and we get the closing bells here in New York. We should also point out we get some other earnings as well out of Lam Research, Las Vegas Sands, Whirlpool, and IBM. But obviously, Microsoft, Meta, and Tesla are going to be the big focus in just a few minutes. The closing bells here in New York, unchanged on the Dow Jones Industrial Average, unchanged on the S&P 500, up about 0.1% on the NASDAQ, and the Russell 2000 lower on the day by about 0.5%.
All right, guys, and just taking a quick check here on the S&P 500. It's funny, I had NI earnings up, and I was just like, have they come across yet? You've got 190 names, Katie, to the upside, 313 to the downside.
All right, let's take a look at the sector performance as we count down. Slightly more losers than winners. In terms of what did perform today, energy putting up a gain of about 0.7%. Tech up about 0.6% as we await these ginormous earnings. Materials, communication services also in the green. In terms of what didn't perform so hot today on this Fed day, real estate down by 0.9%. Consumer staples, Carol, also off by about 0.8%.
Microsoft earnings crossing the wire right now. First here on Bloomberg, we take a look at the headline number. Revenue in the most recent quarter, $81.27 billion. The street was looking for 80.3. EPS coming in at $5.16 a share. I don't have a comparison for you just yet, but here's the intelligent cloud business. $32.91 billion, relatively in line with estimates. The street was looking on average for 32.39. And we should also point at Azure and other cloud revenue, ex-FX, that was up 38% in the quarter, right around what the street was looking for. Carol?
All right. Let's go to Meta, also crossing the Bloomberg terminal as we speak. I'm going to go right to the outlook. The first quarter revenue, looking at $53.5 billion to $56.5. The street estimate was for $51.27 billion. The stock right now bopping around, but lower, just about 0.9 to the downside. Now maybe kicking a little bit higher. Let's go to the fourth quarter revenue, $59.89 billion, better than the street estimate of $58.42 billion. Ad revenue, so important. Let's see whether or not all those AI investments are paying off when it comes to getting more eyeballs and more ad revenue. $58.14 billion. That is a beat. 56.79 was the street estimate. And also EPS, $8.88 a share versus $8.02 the year before.
Yeah.
So again, that stock, though, a little bit lower, down about 1% here in the aftermarket.
That CapEx number,
yes.
guys. 2026, companies saying CapEx $115 billion to $135 billion. The street was looking for about 110. So Meta and, more importantly, Mark Zuckerberg still all in here on the AI build-out.
Well, to that point, Mark Zuckerberg saying that we had strong business performance in 2025. I'm looking forward to advancing personal superintelligence for people around the world in 2026. Lofty ambitions, of course, but as you can see in the after-hours reaction, investors want to know, how do you translate that into actual profits and revenue and the bottom line here?
I want to go back to this CapEx here. It's in the press release. It's a headline in the Bloomberg. We anticipate 2026 capital expenditures, including principal payments on finance leases, to be in the range of $115 to $135 billion, with year-over-year growth driven by increased investments to support our Meta Superintelligence Labs efforts and core business. That is so much higher, and that is also a much bigger range than I would have anticipated, up to $135 billion to spend on CapEx.
And just adding to that, the total expense number, 162 to 169 billion. The street was looking for 151. And this really gets to the idea. I mean, we can quibble over the numbers from a fundamental basis, but we've seen this before with Mark Zuckerberg, where when he basically decides he wants to go all in something, whether it was the metaverse and the no legs people or some of the actual hardware stuff, he goes all in.
Yeah.
Doesn't always sort of pay off, but he certainly makes big rolls of the dice.
To your point, Superintelligence Labs, the idea of superintelligence, artificial intelligence, that's throughout the press release. The word metaverse, not in here at all. This company rebranded from Facebook to Meta because Mark Zuckerberg a few years ago was going all in on the metaverse, that pivot. It's completely to AI. I'm
going to go back to, though, Microsoft right now, down about 7.6% here.
Can I just want, but just at that point before you move on, too. I mean, the Reality Labs business, I mean, to your point, Tim, that's down 12% year over year. There's no real business there. It's $955 million, which would not be an issue if this wasn't like, a $58 billion quarter company.
Totally.
This is an advertising company. Yep. Full stop.
No question.
Also, when it comes, to that pivot to the metaverse, remember earlier this month that Bloomberg reported that Meta is beginning job cuts months, basically in Reality Labs as it shifts from the metaverse to its AI devices. So yes, Zuckerberg tends to go all in, but that doesn't mean also that he doesn't occasionally shift away as well.
All right, I want to go back to Microsoft because it's down about 7% here in the aftermarket. This is after the company, again, CapEx is something we're talking about a lot for these companies, but also Azure, always important for this company. Second quarter Azure, another cloud revenue ex currency up 38%. That's what the street was expecting. And I think it's safe to say with the spend that we continue to see with these companies, people are looking for even better numbers when it comes to that.
Yeah, actually, guys, let's jump to Tesla here. These numbers starting to trickle out right now. The EPS numbers coming in right now at 50 cents a share. That does look like a beat. The street was looking on average for about 45 cents. That's all the numbers we have right now. It's going to take a while to parse through the Tesla release because, of course, they don't follow normal formatting for anything here. But those shares slightly lower in the after-hours trade, 1% down.
Yeah, absolutely. It's going to be interesting to get some of these figures here. It is interesting to see that price targets from the sell side have been rising, even as Tesla's profit outlook really in question. You can see shares now down about 1% here as we start to get some more of these numbers, Tim.
Okay, fourth quarter gross margin, 20.1%. That beat estimates of 17.1%. Fourth quarter operating income coming in above estimates at $1.41 billion. Fourth quarter revenue coming in just shy of $25 billion at $24.9 billion. That was just below estimates. Fourth quarter earnings per share coming in at 24 cents. Versus 66 cents, that's year over year. So that was not an estimate, but 24 cents for fourth quarter EPS. Fourth quarter free cash flow, $1.42 billion. The estimate there was for $1.59 billion.
I mean, to be fair, and just listening to some of our team talk about from the Bloomberg Intelligence team, you know, what you want to hear from Tesla, there's a lot of folks want to hear about self-driving cars, autonomous cars, the taxi, and they also want to hear about robotics because that is seen as the future of this company.
Yeah, free cash flow in the quarter for Tesla, $1.42 billion. That's slightly below estimates. But I want to go back to Katie's point, too, because I think she was referencing the great story that was on the Bloomberg terminal, just about how insane this valuation is. Yes. And the idea that a lot of investors don't think it's insane. This isn't really a bet on cash flow or profitability, at least not in the short term.
Or cars.
It's a bet on, exactly, Tim. It's bet on these moonshots that we know Elon Musk is great at least advocating for. Whether he actually delivers on them, that's a whole nother question. But he is the consummate salesman. He has focused our attention less on those cars, less on the cash generated from those cars, and more on whether Katie's going to have a humanoid robot to make her omelet in the morning.
Which he did say last week at Davos she would have in the next year.
Yeah, theoretically. I will say, to put it even more directly, I mean, it's a bet on Elon Musk specifically, Elon Musk's ability to sort of engineer those moonshots. You think about the Musk premium in relation to Tesla shares. We've never actually exactly found out what that is, but I mean, you compare Tesla to some of the other car companies out there. It's in just a completely different league, and it has been for years now. Yeah,
it's not even valued as an auto company. On that, investors valuing this report, at least the knee-jerk reaction, now higher by 3.8%. Shares did initially drop on the release, but now shares are up for Tesla 3.8%. Close to 4%.
The company saying that it does plan to invest further in those autonomous robots and the infrastructure for that. It also says that Cybercab, the Semi, and Megapack 3, that's still on schedule, Katie Greifeld, for 2026. So Elon Musk, once again, laying out some of these long-term looks here and saying that maybe, at least this year, we might start to see some of that stuff come online.
Well, you can see that faith expressed right now in the after-hours reaction. Let's quickly pivot here to international business machines. IBM, the red headline here, that fourth quarter revenue came in at $19.69 billion. That is above the estimate of $19.21 billion. They see their full year cash flow increasing by about $1 billion year over year. Their fourth quarter free cash flow came in at $7.55 billion. That is above the estimate of about $6.85 billion. IBM shares higher by about 2% right now.
All right, let's go back to Tesla. Again, getting some commentary about some of the future, perhaps, revenue drivers. And this is what investors are kind of banking on. But we are talking about, Romain mentioned this, the Cybercab, Semi, and Megapack 3 on schedule for 2026. That's this year. Tesla to invest further in autonomous robots, infrastructure, and ramping 6 new production lines across products. And so we're continuing to look now at Tesla, now up about 3.4% here in the aftermarket.
You know, I'm going through some more numbers here coming out of Microsoft here. We're talking about a company with $81 billion in revenue in the most recent quarter, an operating income of about $38 billion. The company's saying, though, of that income, at least on the net income basis. About $7.6 billion of that actually came from its investments, a gain on its investments in OpenAI. I know, Katie Greifeld, you're always concerned about the Ouroboros here, this sort of circular thing here, but at least in the short term, maybe a little bit of a benefit of some of those investments here, so contributing to the company's bottom line.
There you have it.
All right, just a quick check. Meta Platforms up about 3% here in the aftermarket. Microsoft down about 5.3%. And then we've got Tesla, which has been bouncing around. That one is right now, as I pull it up about 3.6% here in the aftermarket. So we'll be looking forward to those calls with the analyst and investment community. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Katie and Romaine, of course, continuing there on the close, and Tim and I continuing right here in the fishbowl on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. Microsoft, Tesla, IBM, and Meta all reporting earnings right now. The shares oscillating for all of the names here, but overall, we are seeing some moves to the upside. John Belton joins us right now, a portfolio manager over at the Gabelli Funds. And John, I want to start off first with Microsoft here. Those shares are down about 5%. Some concerns about their costs. Also, I guess some concerns here about some of the obligations that they've entered into. I know you only had a few minutes to sort of look at these earnings here, but was there anything that gave you concern?
Well, I think the Azure number is maybe a tiny bit light of expectations. But the important thing here is they don't provide guidance until the earnings call. So I think you have to wait until what they say on the call. They'll guide Azure for the March quarter. I think the guidance there should be solid, and hopefully they'll attribute maybe the slightly slower December quarter to supply constraints. So I still think this remains to be seen how the market to this print.
I just also want to just hit quickly for our viewers a red headline crossing right now on Tesla. The company saying that it plans to invest $2 billion to buy a new round of preferred shares of XAI. Of course, that's Elon Musk's AI venture here. We'll keep an eye on that as well. One interesting theme, though, John, that I've seen out of, at least so far in the statements by Meta, by Tesla, and Microsoft is this commitment to continue spending in the AI space. I know there was some concern as to whether they were spending too much, whether we would see a return anytime soon, or whether their conviction on it would waver.
Well, I think Meta's headline numbers are a really interesting reflection of the market's attitude towards this right now, because their CapEx and OpEx guides for 2026 were both way ahead of even some of the higher estimates I'd seen out there. And so all else equal, the market would typically be concerned about that. But big revenue guide for 1Q, and they're talking about still growing operating income in 2026, which suggests that revenue estimates need to come up. Those two things are obviously related. They're spending more on AI. That AI is allowing them to grow faster for longer in their core ads business.
Well, let's talk about some of Microsoft's products here. You think about 365 Pilot. There's been a lot of concern about some of the new releases coming from Anthropic, for example. You think about Claude Cowork. You take a look at some of the reviews from earlier this month. They're absolutely glowing. I mean, what does that long-term mean for a name potentially like Microsoft?
Well, there's a lot of debate right now in the market about, these incumbent software companies. Are they going to be disrupted by, new AI upstarts and even by the model companies themselves, or are they going to become distributors of, AI model technology? And I think it's going to be really interesting to hear what Microsoft has to say about that tonight. I think Microsoft is well positioned to, distribute AI technology through their productivity apps. And I think on Copilot, there's the sentiment there in the market is very negative. I think that's going a little bit better than people give it credit for. And a lot of times historically, it's taken Microsoft some time to figure these things out, but they have the distribution in the end. They have a lot of built-in advantages, and a lot of times they do end up coming out on top.
And I do want to compare and contrast a little bit when it comes to Meta, when it comes to Microsoft, because the point has been made when it comes to CapEx that Meta is potentially even under more pressure than a name like Microsoft, given that Meta doesn't actually have a cloud computing business. And I wonder what you make of that theory, how it affects how you view these two names.
Well, I do think it's a good question. I do think Meta has other ways to monetize AI at scale today, and specifically that's through their core ads business. I mean, it's no secret, or it's very clear now that AI is helping with their content recommendation algorithms. It's helping with their ad targeting. It's helping with their ad measurement. It's even helping with ad creative now. So, they're spending a lot of their CapEx is going towards supporting their own existing business. I think you also do have a portion of their CapEx that's going towards their model building, their kind of generative AI initiatives. And to your point, that's not directly being monetized today. But I think the market probably views some of the AI cloud infrastructure businesses as lower quality. So we'll just have to see how that all evolves.
I am curious that just as an investor in this space, and just the idea of how long of a runway you're willing to give these companies, and more importantly, the executives sort of leading the charge on this spend and the actual return at some point. I mean, I know you get the returns, at least in terms of the stock price appreciation, but at some point, the fundamentals do have to kind of sync up with some of these valuations.
Right, but I think Meta is an example where the valuation really is not that demanding, and the returns are enormous today. It's just the returns are not coming on the generative AI side of the business. The returns are coming in their core business, which is being helped by AI infrastructure. So I think it's a little bit case by case. It's a little bit complicated. Microsoft and Amazon, in terms of their return on all this spend, I actually view them as more the adults in the room. I think they're going at more of a measured pace in terms of building out more infrastructure. The market clearly would like them to go even faster. And I think that's why that's been the constraining factor on Azure and, in Amazon's case, AWS growth. But I think it's case by case. But by and large, the biggest companies, I think, are already generating pretty decent returns. They're trading at relatively digestible multiples, especially in the context of the broader market. And they're going at a measured pace.
Well, John, I'd like to ask specifically how much of a runway you're willing to give a name such as Tesla, for example, because, I mean, we were just talking about it with our radio colleagues that you think about what the future of Tesla is supposed to be. It's supposed to be an AI company. We're talking about, autonomous vehicles and humanoid robots, but it's a matter of timelines, right? Because that future isn't actualized right now. So how do you think about a name like Tesla that has those ambitions, but seems like we're several years, if not more, away from realizing them?
It's a very unique stock. And a lot of people say, oh, the valuation is crazy. There is no valuation support. And on near-term numbers, I agree, but I do think Tesla's a stock that trades on very long-term earnings expectations. And I think when it comes to what they're doing with AI, there should be a nearer-term unlock in demand if they're able to get licensed to roll out FSD on an unsupervised basis in the U.S. I think that's going to be a killer application for AI, and FSD is clearly something that works. There was a really interesting story a couple weeks ago where this P&C insurer, Lemonade, is offering their customers 50% off if they're using Tesla FSD. So the data clearly suggests that Tesla FSD is working. A lot of what they're doing with AI is working. It's just, it's going to take time before they're able to get the regulatory clearance to roll it out on an unsupervised basis in their cars. But then, to your earlier, you've talked about it already, but what they're doing in so many other areas that could be needle movers long term. So they have this big energy storage business today. They're doing things with robo-taxi, expanding that program throughout the year, and then longer term things like humanoid robots. Who knows what that could turn into? But it all kind of it supports the long-term earnings estimates that I think Tesla is valued on.
Yeah, it's a good point when it comes to their energy storage business, often overlooked when it comes to some of the other shiny objects that Tesla has. John, great to get some time with you. Really appreciate it. That is John Belton. He is a portfolio manager and managing director for growth portfolios over at Gabelli Funds. Let's keep the conversation going on Microsoft, Meta, and IBM with Gil Luria. He is D.A. Davidson's head of technology research. Gil, great to have you with us. Let's start with Microsoft. It was your top pick heading into this round of reporting. And how do you feel having had a few minutes to take a look at some of these numbers?
Yeah, it's still our top pick. Investors may have expected 39 to 40% growth in Azure. They got 38%. That's probably the only place where I see people picking on it. But realistically speaking, let's not forget, Microsoft doesn't put Outlook in its press release. So we're going to have to wait to see what the outlook is for Azure. And then most importantly, let's not forget, Google Cloud that reports next week is not going to grow 38%. It's more likely to grow in the low 30s. Amazon Web Services reports next week. They're more likely to grow in the low 20s. Azure is still winning. It just didn't quite meet those very, very high expectations.
Well, it's an interesting point when you think about how these different names are being treated in the stock market. Microsoft, one of the top or bottom two worst performing names in the Magnificent Seven over the past 3 months. And then you make the point in your notes that Alphabet is trading towards the high end of its historic multiple range. So, I mean, how do you explain that when you take a look at, again, just the treatment of these two different cloud businesses?
Yeah, a lot of it's narrative driven. Google is now not just considered a winner in AI, it's considered the winner in AI. We'll see what they say next week. But again, realistically speaking, Google Cloud growing slower than Azure. Google Ads growing slower than Meta. So the fact that Google is trading at a premium to Microsoft and Meta really is a matter of momentum from last year, from Google coming from being considered a loser just a few months ago, was trading at 18 times earnings, to being considered the winner, trading at closer to 30 times earnings on next year. So it's swung pretty widely. We expect Microsoft to outperform significantly this year as it gets credit for this Azure growth. Part of what's plagued Microsoft are a couple of things. One is this anti-software narrative, this narrative that AI will replace all of software. Microsoft, having such a big software business, would be part of that. We don't agree with that, obviously. We think AI will get integrated into all of Microsoft products and make them better. Yeah. And the second one is the OpenAI concern, right? Is OpenAI going to be able to raise capital? If it isn't able to raise capital, can it continue to grow as a big engine for Microsoft? That's very important. So as we look at OpenAI's fundraising, if they could raise 50 billion or more, which is being reported, Microsoft will be fine because ChatGPT will continue to drive growth. And again, they're growing faster than Google and Amazon.
I am curious, though, on the software side, Gil, and particularly with some of the other companies you cover. I mean, what about some of the other software companies, particularly the software services companies, the application software companies? We got earnings out of ServiceNow just a little while ago. Those shares under pressure here. The numbers weren't bad, but there seems to be a lot of people, as you said, they're kind of dumping a lot of software stocks with the idea that some of these folks aren't necessarily going to be the primary beneficiaries of the AI boom.
There's an illusion that this is a zero-sum game. It is not. AI can and will be wildly successful as we all use it to become more productive. And at the same time, good software companies, which by the way includes ServiceNow, will do very well because a lot of the things they do, AI can't replicate, not anytime soon. How they're integrated, how they're customized to a company, the workflows, the integrations, the data governance, those are things AI is many years away from being able to help. So these software packages will continue to be the heart of how enterprises run their technology stack. It's just that we're also going to get AI tools, not only as consumers, but as employees that help make us more productive. So this narrative that it's zero sum, that it's either AI succeeds or software, is entirely false. We expect a lot of these really good software companies to do very well this year.
Gil, I am curious, though, too, as we sort of move forward in this, and I know there's been so much focus on some of these eye-popping CapEx numbers, Meta obviously raising its forecast for what it's going to spend here. Are you concerned at all about where the money is coming from? I mean, initially the narrative was this is just cash they all had on hand, but now we've seen some of these companies start to go to the debt markets, and there's expectations we could see a lot more activity in the corporate debt space as they now rely a little bit more on borrowing to fund this stream.
Yeah, so Microsoft, Amazon, and Google still have as much cash as they want and generate so much cash flow, even after all this CapEx, that investment is very, very secure. And we're going to hear that later from Microsoft. For Meta, this is more of a bet. As you heard earlier, their CapEx isn't actually to support their business. A very small part of their CapEx is aimed at making Meta's ads better. Now, they're very effective at it. The revenue results and the revenue guidance were extraordinarily good for Meta. We're talking still about a company that's growing close to 25%, even at this scale, but they're investing CapEx well above what they need. Their cash flow may not support that forever. They're going to the debt markets. They still have capacity. Our concern about spend is about marginal players, Oracle, CoreWeave, Blue Owl, all these companies that are going out there tapping the debt markets at either very low investment grade debt or sometimes below investment grade debt to build for really speculative investment. That's where we worry. We're not worried about Microsoft, Amazon, and Google because they have all the customers. Those customers are spending, and those companies are building data centers with a very low cost of capital for customer commitments that already exist. So that should sustain.
Gil, always a pleasure. Gil Luria, D.A. Davidson's head of technology research. A quick check here in the post-market. Microsoft down 4%, ServiceNow down 3%. To the upside, though, you have Meta Platforms up about 8%, IBM, which we haven't actually talked about, up about 8%, and Tesla shares now up roughly about 2% here on the day. I can walk you through the numbers that Tesla just reported, but quite frankly, I'm not really sure they matter. The real headline here seems to be the continuing melding of all of Elon Musk's business all around, at least for right now, is his main public vehicle, and that is Tesla, including news that it will invest $2 billion to buy preferred shares of his AI company, xAI. Bloomberg Tech co-host Ed Ludlow joining us right now to talk a little bit more about, I guess, the blurred lines when it comes to this Tesla business, and which, quite frankly, might be the appeal for a lot of investors.
Yeah, Tesla participated in the Series E, $2 billion of preferred stock. And actually, in the fine print of the shareholder deck, they even go further and explain the rationale that they have arranged a framework where Tesla can leverage xAI's work in models to accelerate what Tesla wants to do in the physical world. In other words, humanoid robotics and autonomous driving. Like in the deck, you're absolutely right, Romain. This could not be more clear. The bread and butter legacy business of selling EVs to consumers, even the high-flying energy storage business, is now kind of secondary to this focus of Tesla becoming a physical AI company. Reminder that actually, when shareholders voted on the non-binding proposal for Tesla to invest in xAI in November, a lot of shareholders abstained because xAI is a startup that's burning through billions of dollars of cash each quarter. And so even the most bullish names on Tesla look at that and say, do you want Tesla, which is doing its own internal work on software and hardware and AI, to be carrying the bag on a loss-making business like xAI? But they've pulled the trigger nonetheless.
Yeah, burning through billions when it comes to xAI, but set to get another $2 billion from Tesla. You mentioned that, this is more about Tesla transitioning to a physical AI company, but let's talk a little bit about the core business as it stands right now, because you take a look at fourth quarter profits, Ed, and actually they weren't that bad.
Weren't that bad. There was growth in FSD subscriptions in the fourth quarter. Active subscriptions in FSD now 1.1 million. And what Tesla does, like loads of companies, is put the plus and minus columns together of factors. They're saying that going forward, profit is going to be boosted by software sales, which if you believe in that long-term Tesla thesis, you want to hear. I'm just looking at the Bloomberg, and honestly, it's so important to just go back and check the data. We know what happened in 2025 with the second consecutive slide in deliveries, shrinking deliveries growth, but this was the first drop in annual revenues. So while Tesla's been able to offset the drop in consumer EV deliveries, bringing revenues from other places, revenue overall did fall year on year in 2025. And people will look at that because you have to remember that for all these long-term AI-related goals, the board still requires Elon Musk as a mandatory target for his $1 trillion of potential compensation to deliver 20 million EVs to consumers over that period, meaning he has to average 500,000. But yeah, AI everything, and I got a lot more questions about Fab, SpaceX, everything else for the call.
All right, Ed, really appreciate your reporting. That is Bloomberg Tech co-host Ed Ludlow. And let's get more on Tesla earnings and the broader tech space with Ross Gerber. He is the co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. Ross, great to have you with us. I want to go to this line from your notes because this really encapsulates the entire conversation on Tesla as I see it. Investor sentiment appears driven more by long-term narrative than by near-term fundamentals. You can certainly see that playing out in the stock price, in the valuations. But you take a look at the near-term fundamentals, as we were just discussing with Ed, adjusted earnings per share came in at 50 cents in the latest quarter. That is higher than analyst estimates. What do you make of some of these figures?
Well, energy storage did really well, and this is a really good business for Tesla, and they're continuing to double down in energy storage because the demand for energy is sort of like unlimited right now. So it's really nice to see that part of the business doing well with the deterioration of their core EV business. So that helped offset some of the decline, and certainly being profitable in charging and in energy storage helps offset the losses now that the EV company is having. But it still points to when in this future will Tesla actually generate new revenue from any of the things that Elon's talking about.
Well, on that note, I'm curious to hear what you make of that $2 billion agreement to invest into XAI. Again, as we were discussing with Ed, the AI business theoretically will help power some of those initiatives when you think about humanoid robots, when you think about full self-driving, for example. And I'm curious what you make of it.
Well, it's also powering pornography and other pretty nefarious things. So, Tesla shareholders are now involved with that. And so, I think that XAI investment from Tesla, is sort of a weird thing considering they took Tesla's chips and engineers to make XAI, and now we're paying for it. Why isn't XAI a part of Tesla? It should have been from the beginning. I don't know. But those are questions shareholders can decide. I think it makes sense for Tesla to invest in XAI. They have $44 billion in cash doing nothing. And so Elon needs the money to build XAI. And so he's going to use Tesla for that money. And I don't think shareholders should be confused. Elon's going to do what he wants with his money to support his money-losing operations.
Yeah, and it's really shareholders' money, too, not to be pedantic about it. But
no, it's not. It's not. The shareholders have no say in this company. It is not a traditional investment like other companies. It's Elon's company, and Elon will do as he wishes with his money. And that's, if you invest with him, you are riding on the back of the bus, and you better enjoy it.
All right, Ross, fair enough. So I have a question, though, about that money and whether that becomes a concern, given the numbers that we saw with the 3% drop in revenue, as Ed was talking about, 30% drop in free cash flow, capital expenditures going up. And he lays out, I don't know when this stuff is going to materialize, but the Cybercab, the Tesla Semi, and all these other things that he says are on schedule for volume production in 2026. I mean, I almost hate to ask you this question, but are these realistic goals?
Why do you hate to ask me the question? Because you know it's absurd.
Okay.
Yeah. I mean, right. I think that's how you frame the question is when he says these things, they have no credibility. I call them hallucinations. They're visions that he sees that he hopes to be true, but aren't. And so I think investors have to be aware it's going to be many years before the Cybercab is a real business, and certainly robots, I don't even know how long. And I think investors are fine with this sort of like long-term vision of Tesla, obviously by the stock price. But I think when you're talking about like business economic fundamentals of the company, they've been deteriorating for the last 3 or 4 years. And you can see it in the annual numbers that they put in the shareholder deck with margins and profits just going down consistently. So, you can kind of put this in any way you want. It's 100% bet on Elon and the stuff working out. And I just don't know.
Well, I mean, and to that point, I mean, look, I mean, anyone with the Bloomberg terminal, really any sort of functionality with regards to look at their earnings trajectory, you can sort of see where this company is headed. But at the same time, we've been writing a lot on Bloomberg about the valuation, the multiples, the fundamental multiples for this company, which are just miles ahead of almost every other company out there. And I mean, you know this, Ross. We went through this a few years ago where everybody was looking at the fundamentals and they were awful. And yet we still saw that multiple continue to rise, and people are putting much more of a premium on the future and to a certain extent on the ties to other parts of the Elon Musk ecosystem.
100%. And I think if you look at it from a shareholder perspective, this is a stock that has gone nowhere over the last 4 years. And so, when you look at its 5-year return compared to the S&P, it's now less than half the return if you just invested in the market. So Tesla shareholders aren't doing so great. It's not like if you invested in Tesla 5 years ago, you're like rich now compared to investing in NVIDIA, for example, which is one of our top holdings at my firm. And so, you know, when you actually compare Tesla's performance to its peers, whether it be Google or Microsoft or Meta or whatever, it's not very good. And so investors are paying the price for this because there's a limit to what outrageous valuation people are willing to assign to this. So it used to be 100 times earnings was Tesla's sort of like multiple for a long time. Now we're trading at 250, 300 times earnings with earnings not going up.
Yeah.
You know, it's like gravity will eventually come. And so one way or another, either they're going to deliver on the promises this year or gravity is going to come for Tesla. And that's why I say this year is a pivotal year for the company. And I hope they can deliver. But, you know, let's be real. They've got a lot of challenges in front of them.
And just to be clear, at least on the Bloomberg terminal right now, we're looking at about 198 times forward earnings. It only takes a couple hundred years to get your money back.
Yeah,
but I think those forward earnings numbers are wrong.
Okay, fair enough. Well, that's what the terminal says. So, Ross, that's the Bible we live by. Ross, before we let you go, I really want to talk about Apple because they report earnings tomorrow, which we will be breaking down on the close. I was reading some of your tweets coming from yesterday. You write that Apple completely missed the boat on AI. No excuses. Tim Cook needs to go. You're not exactly alone in that opinion, but what would Tim Cook exiting as CEO actually do for Apple? What kind of CEO do you want to see at the helm of this company?
Well, I'd like to see somebody very engaged with the future. So like if you compare Tesla, which is like 100% hope of the future, to Apple, which is 100% we've done nothing to prepare for the future, it's like they have this monopoly in hardware. They make the best hardware, let's be real. But it's like their software is just not great. You know, even the new iOS updates, they're more annoying. It's basically, and they make the phone more annoying to use with every update, not less. And then it's like you start saying to yourself, like, these form factors are bad. Like, what has Tim Cook done? And then AI comes rolling around, and Apple Intelligence is literally Apple unintelligence. And they should have built out, and they should have been like a hyperscaler like Google and built their own. Like Elon's built like a bunch of these, you know, AI server farms like rapidly. Apple has zero. So now for the rest of their lives, they're going to have to use Google, which is now one of my top investments, over Apple, because Google's going to be the big winner from Apple. But one thing that they have to consider, the future is not on the phone. They have to consider that the future might be glasses that Meta's working on, and watches, or other devices, or no device at all because AI gets so good. They can't just assume their hardware ecosystem monopoly will last forever. And they need a young, smart leader that can get the software up. You know, like we need to go all in on software and make just an incredible AI operating system.
All right, well, maybe we find that out tomorrow when they report earnings. Ross, always appreciate your candor. Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki Wealth and Investment Management. And Katie, we do get those Apple results tomorrow. And there has been a lot of speculation as to whether they will maybe make some announcement, not necessarily whether Tim Cook will be replaced, but whether they have started succession planning. For Mark Gurman has been reporting about Turnus being elevated to oversee more of the hardware and software design business, and that might be a sign that the board maybe sees him as the heir apparent.
Yeah, absolutely. I mean, you think about Tim Cook, he's 65 years old, so not old, but not young. And he's been at the company, I believe, at the helm since 2011. So it's been quite a long tenure at this point.
A long tenure, and we should point out, at least based on share price, it has been a successful tenure, also based on some of the revenue and profitability, but a lot of questions about innovation going forward. And quite frankly, that's been a big question for a lot of these big cap tech names. The idea that over the last couple of decades, they were the innovators. Are they still? Well, let's bring in our next guest right now. Dan Newman joins us right now, CEO of the Futurum Group, to help break down some of the earnings that we have. But before we just talk about the moves that we saw here on this day, Dan, I do just want to get your more broad, longer-term take on some of these Mag 7 names. I mean, they've underperformed the broader market for the last couple of months since hitting some of those record highs back in, I think, kind of the fall, October, November, if you will. And there does seem to be this weird sort of investor dynamic where people are seeming to start to look elsewhere for where the next tech trade is. Do you still have faith in these names?
Hey, Romaine, good to see you. Yeah, I do still have faith. And I think so far what we've seen today, largely they delivered. I agree with the last guest about Tesla. That company's never a story about how it's actually doing. It's a group of investors that truly just believe in what Elon Musk says will happen. But Microsoft is delivering. Meta, I mean, there's a company, and Meta and Amazon were both two of our best ideas. These are companies that are truly building the future. They're investing significantly and investing more than even the market tends to believe each quarter. Each quarter we keep seeing this CapEx number go up because they are the ones that understand that they have to build the rails of the future. Yeah. NVIDIA has traded sideways, to your point, for almost 2 quarters now. And it just keeps growing and growing to the point now where you start to look at the valuation and you go, this may actually be cheap if it's able to meet that $500 billion order book and deliver what 300 plus billion, in these coming years. So I think the innovation is still there, but I also do think that Google, for instance, had that incredible run, Romain, and people are wanting to see other things now.
Yeah. Well, I do want to go back to Meta for a second, Dan. I mean, when we were bringing you in, we showed a great chart with the sort of the big ramp up in CapEx spend. And we saw the eye-popping numbers, $115 to $135 billion projection for CapEx. That's above what the street was looking for. But our analysts at Bloomberg Intelligence actually see that as potentially a good sign, saying that it suggests, in their words, that there is sort of a big focus on training and inferencing workloads in anticipation of some sort of AI release, AI assistant release here. And I guess to this idea that when you look at that CapEx spend, and I'm talking specifically for Meta, what do you think Zuckerberg is trying to do with that money?
Well, first of all, last year they made all those investments in people, and a lot of us out there that were analyzing it were going, are they overspending? And so what I think happened, and you heard about Meta Cloud, is that Mark Zuckerberg has turned the corner. It was all about models. So people were getting a little impatient. Are they going to release the next model? Is China getting ahead of them with open source? Are these frontier model labs beating? Is Meta on the sidelines? Did they waste all that spend? And I think they've been in the lab doing things. And I think what Zuck understands is that compute is actually going to be the metric of whether or not these companies are going to be able to stay flexible enough to be successful in the future. So, Romain, what I really mean by that is some companies right now think the model themselves are the differentiator. We're seeing Anthropic and OpenAI and Gemini, they're leapfrogging each other quarter after quarter. Mark is saying if we have enough compute, we already have our advertising business. We're making money in AI because of this moat. If we have the flexibility to continue to build, to continue to innovate, we can stay ahead, continue to deliver AI ROI. And the key to doing this is going to be CapEx and having that massive amount of compute. He's doing the right thing. It will be the differentiator. It's interesting, though, and I know that Meta was one of your top ideas for 2026. I mean, both Meta and Microsoft, it seems like markets, this after-hours results notwithstanding, are totally unimpressed. You think about the performance relative to some of their Magnificent Seven peers over the past 3 months, Meta and Microsoft down in the dumps. Microsoft is a really interesting one, too, because as we were discussing earlier, I mean, you think about their cloud growth, it's best in class, but you wouldn't necessarily know it by looking at their shares. Yeah, the reaction today is a little bit surprising. I mean, obviously, Meta, you're seeing they're getting a big pop. I think people are starting to see what they're doing in their numbers and their guide. But let's talk about Microsoft. I think the big reason Microsoft is falling after hours has to do with that RPO number being looked at against the OpenAI commit. Oracle suffered a fate there with that big backlog. Everyone got really excited, and then you saw it basically got halved. Microsoft's very different, and I do think we're going to have to wait for that earnings call where we're going to hear from Amy Hood. I think what the market's going to want to hear is how much of that $620 billion in backlog is OpenAI. I believe it will likely be half or less, which is half is still a massive number for OpenAI, but it's not like with Oracle where it was like 80-90% of that number was one company. Microsoft's very diversified. Its cloud business is best in class growth. It's $200 billion now. And they have so many different revenue buckets. I do think they need to keep working on Copilot, keep up. Yes, Anthropic and Claude have been very disruptive, but they're still so deeply entrenched in every enterprise. And that $620 billion number it's a huge number, and the market should be looking at that positively if it wasn't too concentrated in OpenAI. Dan, 30 seconds here. You mentioned it. When you think about Anthropic, what's going on with Claude, you think about Microsoft's stable of products. I mean, how big of a risk is that when you take a look at the long term? I think over the long term, there are some companies where AI will eat software. I look at ServiceNow that reported today. I look at IBM. I look at Microsoft. These are deeply entrenched companies. I think a lot of the features, project management suite, some HR tools, they definitely have some risk of being disrupted. I think there's going to be collaboration between these big labs and these big enterprise software companies, but people are re-rating the entire enterprise software space right now.
All right, Dan, really appreciate your time. That is Daniel Newman. He is CEO of the Futurum Group. Meanwhile, let's take a look at some of the other after-hours earnings movers because, boy, it was a doozy today after the close. We're taking a look at Whirlpool up at the top, down about 6%. Their 2026 ongoing EPS coming in a little bit lighter than estimates. This is a tariff story, as Romaine Bostick told me.
Yeah, I mean, it's interesting, too, here. We talk about a company. I mean, they actually flipped a profit. I mean, they had a loss the previous quarter, but the revenue is still down. I mean, remember, on an annual basis, this is now the fourth straight year they've had declining revenue. They did talk about they found some way to mitigate some of the tariff impact, but now it does look like there's some softness in just sales overall, and you kind of wonder if this becomes less a tariff story going forward, more of a consumer spending one.
Yeah, absolutely. Meanwhile, you're seeing ServiceNow also fall about 6%. Las Vegas Sands, this is an interesting one.
Are we not gambling?
Apparently not, but actually, to that point, Romaine, their fourth quarter adjusted EPS actually beat estimates, but you can see shares are down 10%. Your lone bright spot right now is Southwest Airlines, higher by nearly 7%. This is the close.
Let me start with I don't respond to comments by other officials, whoever they may be. It's just not appropriate to do that. I will tell you why I attended. I would say that that case is perhaps the most important legal case in the Fed's 113-year history. And as I thought about it, I thought it might be hard to explain why I didn't attend. In addition, Paul Volcker went to a Supreme Court case famously in, I guess, 1985 or so. So it's precedented, and I thought it was an appropriate thing, and I did it.
That was Federal Reserve Chairman Jerome Powell answering questions today on why he attended the Supreme Court hearing regarding President Trump's attempt to dismiss Fed Governor Lisa Cook. As we also wait to hear who President Trump's next Fed chair pick will be, let's discuss all of this with Lael Brainard. She is Distinguished Fellow at the Georgetown Center for Financial Markets and Policy. She is also the former Vice Chair of the Federal Reserve and the former NEC Director. It's fantastic to have you with us. There was a lot Jerome Powell did not address today. Nothing on the dollar, nothing on his plans as to whether he'll leave the Fed in May, and nothing really more on political pressure on the Fed, on himself. But he did comment on that case against Lisa Cook, his decision to attend that hearing. Do you agree with that characterization that this potentially is the most important legal case in the Fed's 113-year history?
I do. I think that the Supreme Court case on whether the president can fire a sitting governor of the Federal Reserve Board without any due process and without showing a clear connection to their ability to undertake the responsibilities that they were confirmed by the Senate to do is extremely important for the independence of the Fed. And I think that the press conference, the statement today, just really conveyed the message that the Federal Reserve is doing its job. It is staying out of the political fray. It is looking carefully at the data and making policy exactly on the lines that Congress told it to, which is to preserve a strong labor market, maximum employment, and to get inflation down to 2%. And I think that was the focus of the Federal Reserve chair today in the press conference. Didn't allow himself to get distracted, didn't really get pulled into the political fray.
How much longer, though, do you think that the Fed can stay out of that political fray, especially as we approach May, when the president will have his pick of who to nominate to the Federal Reserve? Of course, the chair is just one of many votes, but even still, you have to imagine that ideologically they will fall in line with the president's thinking on interest rates.
Well, certainly that is important to the president. He has said that many times, that the chair that he selects needs to reflect his views. On the other hand, all of the candidates also will be looking carefully at the data. We heard a lot about the data today from Chair Powell. We saw that the statement reflected the fact that there's been an upgrade to the labor market. There's less concern now about unemployment. And so the new chair is going to have to get support from the remainder of the committee, that committee that's been in place for some time now, if he wants to take the committee in a very different direction. And he'll have to do it based on the dual mandate that was provided by Congress and based on the evolution of the outlook and the data.
I am curious, though, with regards to that data, Lael. I mean, he obviously, a big takeaway from the statement in the press conference was the idea that the economy is kind of a surprisingly stronger. I think I'm kind of paraphrasing his words there than what they thought. So a little bit more stabilization in the labor market. But then towards the end of that press conference, he started talking about, I think what a lot of us has talked about, this K-shaped economy, the idea that, yeah, overall we're doing good, but there is some bifurcation. And I'm wondering if it's the Fed's job to address that, or do they ignore that and just focus on the aggregate?
Well, we're certainly seeing this divergence with strong aggregate growth clearly being driven by the AI boom, the boom in data centers, in semiconductors, in AI infrastructure. But on the other hand, we're seeing the labor market basically treading water, with low hiring, low firing being kind of the characterization really of the last several months in the labor market. And in consumer sentiment, we saw yesterday that the combination of high prices and diminished job opportunities are leading to some real concern on the part of consumers, with the lowest consumer sentiment since 2014, which is a little hard to understand given the pandemic. But the job of the Federal Reserve is to focus on the overall labor market, and it does look like the labor market is in pretty good balance. It certainly has stabilized. We saw some uptick in the unemployment rate, but then in the last month or so, it seems to be holding steady. Yeah. And growth is certainly strong. And of course, you've still got strong inflation, which the chair talked about. Core PCE, which is really their focus, 3.1%.
Yeah. Well, I am curious, though, Lael, too, about another aspect of this. When we talk about the Fed being data dependent, one of the reporters asked him a question about the reliability of the Fed models, specifically in the context of some meaningful structural changes going on in our economy, whether it's the potential avocation for a weaker dollar, obviously a huge shift in trade policies and other things here. And he seemed to suggest that those are, to a certain degree or another, incorporated into the Fed models. Are they?
So, look, I think every policymaker on the FOMC uses a combination of both the Fed's models, but also outside models. They look at private sector forecasts. They talk to business contacts. I certainly talk to community leaders, labor leaders, consumers. You gather as much information as you can about how the economy is likely to evolve. So it's not really driven by a single model. I think that would lead to perhaps much less robust policy making. And of course, you're right that with AI driving potentially a real structural shift in the economy, they have to be getting data from businesses and from workers on the ground to get a sense of that turning point, which is so hard to capture in models that are based on past data and past relationships.
Lael, I have to ask you, with all the things going on in Washington right now, do you have faith, conviction that this will remain an independent Fed?
Well, it will, I think, remain to be seen. It will hinge on whether or not the Supreme Court strengthens the independence of the Federal Reserve by making clear that the for-cause protection that Congress put into the statute in 1935 is really observed, or whether it turns out the president can fire a governor at will, in which case I think the independence of the Federal Reserve will be fundamentally compromised.
Lael, always great to have you. Great insights. Lael Brainard, former vice chair of the Fed, now over at the Georgetown Center for Financial Markets and Policy. As we close out the show here, one of the big gainers in the after-hour trade remains Meta. That conference call going on right now. Those shares up about 9%.
Yeah, it's pretty striking to see this big gain in Meta. We know that it's been underloved, to say the least. Can't necessarily say the same about the reaction in Microsoft, though.
Yeah, and this is a flip-flop. Remember, last quarter, Meta took the brunt of it because of the CapEx spending. Now, I guess some people are now seeing a little bit more of a bright spot. All right, well, let's set you up for what to watch. Tomorrow, we are going to get some more earnings. We start in the morning with, I guess, some more pedestrian names, if you will. Katie Greifeld, Valero.
Yeah, Valero. We also get Sherwin-Williams, Lockheed Martin, Blackstone. The list goes on. I have to say, the real action, in my opinion, starts after the bell.
After the bell, and of course, we get SanDisk, we get Visa, but the star of the show is going to be who else?
Apple, of course. Really interested to see what they can do to sort of dispel that narrative we've been talking about them being behind on AI, if at all.
Yeah, and I mean, actually, to a certain extent, I think people were kind of giving them the benefit of the doubt lately, saying that, well, they weren't spending so much and that was kind of working for them, but we'll find out, I guess, in about 24 hours. Join us then. We'll have full coverage of those earnings out of Apple and the others. Balance of Power is up next.